Welcome back to Money Talks, your guide to the Canadian Securities. This is a big moment for us. This is the final episode of Season 2. We will be back with more exciting topics for the next season. If you have any suggestions, please let us know and we will be glad to prepare an episode about it. A huge thank you to our amazing listeners for your continued support. If you're new here, don't forget to subscribe, like, and share this episode with your friends. Your support helps us create valuable content to boost your financial education and career here in Canada. Today, we have our seasoned financial professional, Jonathan Cartier, back with us. Hey, Jonathan, great to have you on the show again. How's everything going in the market?
Hey, Rita. Thanks for having me. It's an interesting time. The gold rise up above and crypto assets are bullish after several countries start the process of regulating them. In Canada, we are waiting for our proper regulation. The tech sector is driving the market up in the southern border, but some experts stated that it might be a bubble that might burst and lead to a correction or market crash, hoping that this will not be a big hit for small investors, but those crashes could be also an opportunity for those who have cash and want to invest it.
And maybe that is why working with the institutional client might be key to a thriving market. Could you talk about working with the institutional client, the role of strategies, and how they define the collaboration dynamic?
Absolutely. When we talk about the institutional client, we're really talking about the whales of the ocean. These aren't individuals trading on an app. These are legal entities representing the collective financial interests of huge groups like pension funds, mutual funds, insurance companies, and corporate treasuries. To understand how to work with them, you have to understand the two sides of the street, the buy side and the sell side.
I hear those terms constantly, but I think a lot of people mix them up. How do you distinguish between them in the institutional marketplace?
It is the fundamental divide in the industry. The buy side refers to the investors. These are the organizations with the capital. The Ontario Teachers' Pension Plan, a mutual fund at Manulife, or a hedge fund. They are buying securities to manage assets for their beneficiaries. The sell side refers to the investment dealers, the firms that facilitate these trades, create research, and issue new securities. Think of the big banks' capital markets divisions like RBC Capital Markets or TD Securities. They are selling services, ideas, and access to the market.
That's a clear distinction. So the buy side has the money and the strategy, and the sell side provides the machinery to make it happen. Let's zoom in on the buy side for a second. Who are the key players there?
On the buy side, the two critical roles are the portfolio manager and the trader. The portfolio manager, or PM, is the architect. They create the investment mandate. They decide we need to grow this pension fund faster than inflation, or we need to hedge our currency risk. They look at the big picture and decide what to buy or sell to meet those goals.
And the buy-side trader?
They are the builder. Once the PM decides to buy 50,000 shares of a bank stock, the trader has to execute that without driving the price up. They are the PM's ear to the market. They maintain relationships with the sell side, looking for liquidity. They often look at axe sheets, which are lists from sell-side traders showing what they are looking to buy or sell quickly. The buy-side trader's goal is best execution, getting the best price possible.
Okay, so that's the client. Now, let's flip to the sell side, the investment dealers. I know these firms are massive. How are they typically organized?
A sell-side trading firm is like a very high-stakes restaurant. You have the front, middle, and back office. The front office is the dining room. This is sales and trading, corporate finance, and research. They generate the revenue. You have institutional salespeople who manage the relationships and traders who execute the deals. The middle office is like the health inspector and the manager. This includes risk management and compliance. They ensure the front office isn't taking illegal risks or violating rules. They enforce the firewall, which is the information barrier preventing corporate finance bankers from tipping off traders about non-public deals. The back office is the kitchen and accounting. They handle operations and IT. They make sure the trades actually clear and settle.
It sounds like a complex machine. Since the front office generates the revenue, where does that money actually come from? Is it just commissions?
It depends on whether we're talking about equity or fixed income. For equity, yes, commissions are a big part. That's agency trading, where the dealer acts as an agent for the client. But they also make money from spreads in principal trading. That is when the dealer buys stock with their own money and sells it to a client at a slightly higher price. They also earn revenue through prime brokerage, which is a bundled service for hedge funds that includes lending them money, margin, and securities for short selling. Interest on those loans is a huge revenue source.
And for fixed income, bonds are different, right?
Very different. The bond market is over-the-counter, or OTC. There is no central exchange like the TSX for bonds. So revenue here is almost entirely driven by trading spreads. The trader holds an inventory of bonds. If they buy a bond from a client at $99 and sell it to another at $100, that dollar is their profit. They also make money from origination, which is underwriting new debt issues for companies or governments.
You mentioned soft dollar arrangements earlier in our pre-chat. Where does that fit in?
That is a unique revenue quirk. Sometimes an institutional client, like a mutual fund, will pay a dealer a higher commission rate on trades. In exchange, the dealer provides them with free services like expensive research reports or software. The client is paying with soft dollars, commission credits, rather than writing a check.
Fascinating. It's like a loyalty rewards program for million-dollar trades. Now, you mentioned the back office handle settlement. How does that actually work for these massive institutional trades?
It is a process called clearing and settlement. Clearing is confirming the details, like I bought 10,000 shares at $50. Both sides have to agree. Settlement is the actual exchange of cash for securities. In Canada, we use something called straight-through processing, or STP. It's an automated system that links the investment manager, the dealer, and the custodian, the bank, that actually holds the assets. It happens electronically and usually settles in one business day, known as T+1. Without STP, the error rate on these massive volumes would be a nightmare.
At the middle of the episode, I want to take advantage of that nice explanation to stop and ask the audience to subscribe and share the content. You can listen on Spotify, Apple Podcast, YouTube, Audible, and of course on the new website, mtalks.ca. So Jonathan, we've established the structure. Let's talk about the people on the sell side. Who is actually pressing the buttons?
There are 4 distinct roles you need to know. First, the institutional salesperson. They are the relationship manager. Their job is to know the client's needs and pitch the firm's research or inventory. Second, the agency trader, also called a coverage trader. They execute orders for the client. They don't risk the dealer's money. Their goal is to fill the client's order quietly and efficiently. Third, the liability trader. These are the risk takers. They are also known as proprietary or prop traders. They trade the dealer's own capital. If a client wants to sell a huge block of stock instantly, the liability trader might buy it all onto the dealer's books to facilitate the trade. They are reactive to client needs, but also proactive in trying to make a profit for the firm. Finally, the market maker. These are traders assigned specific stocks of responsibility, by the exchange. They are required to maintain a two-sided market, meaning they must always post a bid, or buy price, and an ask, or sell price, to ensure there is always liquidity.
That liability trader role sounds stressful. You're holding the bag if the market turns against you.
Extremely. It requires nerves of steel and deep knowledge of the sector they cover.
Let's shift back to the client, the buy side. They don't all invest the same way. Can you contrast the different investment styles?
Sure. Broadly, you have passive versus active management. Passive is simple, buy and hold or indexing. You buy the S&P TSX 60 and just sit on it. Low turnover, low fees. Active management is where they try to beat the market. In equities, you have value managers looking for undervalued bargains like a beaten-down utility stock. Then you have growth managers looking for the next Shopify, companies with high earnings growth potential. In fixed income, active management involves interest rate anticipation. If a manager thinks rates will fall, they buy long-term bonds to capture the price rise.
And I assume this sell-side salesperson needs to know exactly which style their client uses so they don't pitch a high-risk tech stock to a conservative dividend fund.
Exactly. Pitching the wrong product is the fastest way to lose a client.
We can't talk about modern markets without talking about technology. It feels like computers are doing all the heavy lifting now. Can you define algorithmic trading for us?
Algorithmic trading, or algo trading, is using computer programs to execute trades based on preset rules. Imagine a buy-side client wants to buy 100,000 shares. If they dump that order on the market at once, the price will skyrocket. So they use an algorithm to chop it up into tiny pieces and feed it into the market over hours or days. It minimizes market impact.
And high-frequency trading, is that the same thing?
It is a subset of algo trading, but on steroids. High-frequency trading, or HFT, is about speed, microseconds. HFT firms execute thousands of trades a second to profit from tiny price discrepancies. They aren't investing, they're scalping pennies millions of times a day.
That sounds intense. And finally, what about dark pools? It sounds ominous.
It does, doesn't it? A dark pool is just a private marketplace. On the TSX, everyone sees the order book. It's transparent. In a dark pool, there is no pre-trade transparency. You don't see the orders until the trade is done. Institutional clients use them to trade massive blocks of stock without tipping off the market. If I want to sell 1 million shares, doing it in the light of day might panic other investors. Doing it in a dark pool keeps the price stable.
So it's like a private VIP room for trading.
Exactly. But regulators watch them closely to ensure they don't distort the overall market fairness.
Jonathan, this has been an incredible breakdown. We've covered the ecosystem, the roles, the revenue, and the tech. It really paints a picture of a complex, interconnected machine.
It is a fascinating world. The key takeaway is that while the technology changes, it is still a relationship business. The buy side needs the liquidity and ideas of the sell side, and the sell side needs the order flow of the buy side.
And a big thank you to our listeners for tuning in for Season 2, and we're already looking forward to sharing with you Season 3. The team is working hard to prepare the content. Before we sign off, we have a special gift to help you conquer your CSC exams. Head over to mtalks.ca right now and download our free, concise study guide. It's the perfect way to get a head start. And when you're ready to go all in, we've got an incredible deal for our podcast family. Get 20% off when you purchase our complete bundle. That's both Volume 1 and 2 full study guides, plus all the mock exams. It's everything you need to champion the CSC and take your career to the next level. Join us next time for another episode of Money Talks, your guide to the Canadian Securities. Until then, stay informed and invest wisely. And see you soon on Season 3.